Hi everyone, welcome to my second video. Today I'm going to be talking about Kenmare Resources, a company I invested in last week. It's a little known stock that you probably haven't heard of. It's a miner based in Ireland. And just as a quick disclaimer, I'm not a financial advisor. This is not financial advice. Do your own research, form your own opinions before you invest, and enjoy the process. And on top of that, you can see I've changed the format from my last video, and I'm going to keep doing that, testing out new ways to record, new different formats. So let me know if you like this format or if you don't. To start with, let's talk about Kenmare. Now, I imagine most of you haven't heard of it. It's a mining company, as I said, that mines mineral sands, operates a mine in Mozambique. The mineral sands they produce are mainly used for pigments in paint, plastics, paper, and they're also used to create zircon sand, which is used in ceramic production and other consumer goods. Now, I like this because when the construction industry booms, mineral sand demand increases. That's good for Kenmare. Obviously, that's what they produce. So urbanization, increased demand for housing, they're really good for that mineral sand demand. Obviously, we're not in a great place for that right now, but that's why I wanted to look at Kenmare and why I was interested in what I found, because you're buying this company at a discounted price when there is that stable potential and increasing demand from construction. Obviously, populations keep increasing. We're going to need more housing across the world, and that means that this is a steady, increasing cash flow and demand for the product, which is great. And that's exactly what I want to look for as a value investor who's really keen to find stocks that have longevity. So if we look at the price, so you can see here that Kenmare has not fully recovered from its COVID lows. You could have obviously bought in a lot earlier in April. That would give you already about an 100% return, a little bit less. Personally, I don't like that. I like to wait to see the stock recover a bit. The reason is then you see some investor belief in the company, you see an uptick in sentiment, and I really like that. On top of that, you can see here it's a 250 million market cap. Obviously, that's relatively small, and as an LSE listed company, it's just something I prefer. Obviously, when you're looking at UK stocks, you can have AIM listings, but they come with additional risk. They aren't as well managed. They are a lot less stringent on the demands to AIM list. And while that doesn't rule a company out for investment, for me, it's more a margin of safety to have an LSE listed stock. It'd have to be amazing for me to go into an AIM listing. Looking at why I believe the company is undervalued, start with the PE ratio. Obviously, guys, you don't just look at one ratio, look at lots of different ones. The PE ratio is not the end all and be all of investing, and it's not perfect. So look at lots of different ratios and look at lots of different metrics, means to value a stock, etc. So you can see here that Kenmare has a PE ratio below the industry and below the market, significantly. Now, I like to see that because that means that it is undervalued. It's like a first step. Obviously, I'm not going to invest because of this, but that's like the first step into going further down the process of analysing it. So then if we look at the PEG ratio, this is similar to a PE ratio. What it does is it measures the EPS growth, the PE, the earnings per share, against the expected growth of the company. Now, the reason I look at that is because it shows the trade-off between value and growth. Obviously, I want to buy into a company that's trading at a good value price. But when I'm doing that, I don't want to sacrifice growth. There's a balance there. You don't want a company that's not growing at all just because it's cheap. And you don't want to buy a company that's growing really fast but is way overpriced. So the PEG ratio is great to look at for that. So this, at 0.3, this signals to me as a value investor that it's not only cheap, but also good quality and a growing company. So price to book. Now, I'm a big fan of Ben Graham and other investors like Warren Buffett. And Ben Graham said that he likes to invest in companies below book value, below 2/3. And obviously that's here in the price to book ratio, 0.4, significantly below the industry, significantly below the market. The reason I like it is I just think it shows the discounted value of the stock. So if you're trading below book value, historically, if you're buying below book value, you would have got a huge return on stocks. Obviously, you have to watch for risk of bankruptcy or risk of companies becoming redundant in the modern world, but I think that isn't a risk for Kenmare. I'll explain why later. But yeah, this is a great sign for me. This means there is plenty of room for the stock price to rise and to make a profit on. So, looking at the fair value or the future value of the stock, this is obviously a tricky one. You could go in and model it up yourself. It's a complex process. It requires a lot of assumptions of guesswork. Personally, while I have tried that and will try that again, I like to defer to the professionals in terms of what their estimations are. So here you've got a current price and fair value chart at the top, showing that it's 31% undervalued. That's a little bit less than I normally like. I've been looking at 33 and above, but that's still plenty of room for the stock to appreciate. And not only that fair value will change. So then if you're looking at the one below, you've got the Yahoo Finance 1-year target estimate, which is obviously based off of analysts. And that's a 100% increase in the stock price from where it's trading today. And that's obviously incredible. That'd be a great return. Then below that, you've just got the Reuters analyst data, again showing 4 analysts leaning towards a buy. And that's just really good to see. It's good to have some form of professional backup when I'm looking at a stock. I don't want to be a complete contrarian. Obviously, it pays to be a contrarian, but also, when you're limited on information, limited on time, you're not a massive investor. You want to make sure that you're not just completely stabbing in the dark. Okay, let's look at growth. As I said before, you don't just want cheap. You want a company that's growing, a company that's excelling, a company that will continue to grow. So here you can see the forecast annual earnings growth and the annual revenue growth for Kenmare. It's substantially above the market and substantially above the industry. That's great news for me. That means that analysts are hopeful in how the company will perform going forward, and that's exactly what I want to see. So, the question on everyone's mind right now is, will companies survive? There's been predictions of a high rate of bankruptcies in the US toward the end of the year, and that'll happen elsewhere as well. Now, I think Kenmare has a very high chance of survival. Just look at those short-term and long-term assets to liabilities. The short-term assets cover the long-term liabilities. That's an amazing balance sheet. That strength is really, really good and shows that they will be able to survive and leverage that balance sheet to grow in the future. So if we look at the current ratio, nearly 6, it's incredible. Quick ratio of 4, again, incredible. Obviously, quick is just without inventory. And you can also see there that they have had steadily increasing assets and declining debt. And that's really something I look for because that shows that management are really thinking about shoring up the balance sheet, making it better and improving it. And it's just really good to show charts like that, even if the increases and decreases are small. Again, you can see there that the total debt to equity is tiny, which again is fantastic. So, just a different way of measuring it, looking at debt to equity again and the cash equivalents. You see that it's very healthy. Obviously, there was a slight uptick at the beginning of this year due to coronavirus. They took on some more debt, but the company still has plenty of room to maneuver and expand going forward to leverage that balance sheet to grow. And also, in case there's another lockdown, they have to close the mines again. That just gives them plenty of flexibility. That means that as an investor, you don't have to worry about them going into bankruptcy. So, thanks for listening, guys. Those are the reasons why I've invested in Kenmare. Obviously, as I said, I'm not a financial advisor, so do your own research and form your own opinions before you invest. But yeah, just a quick note. This is the first, obviously, investment I put on my channel. I'm going to be looking to invest in around 10 UK stocks and then some US and then other markets when opportunities arise. And I'll be documenting that process on this channel and also reacting to news. Obviously, my first video was about Boohoo, which was news related. And yes, I'll go from there. So thank you very much for listening, and enjoy the investing process.